You don't need to be a genius in what I do. That's the good thing about it. If I went into physics or so, a whole lot of other subjects, I'd be an also-ran. But I am in a game that you don't need. You probably need 120 points of IQ.
Warren Buffett is the most famous investor of all time, a man who started from nothing and made billions of dollars with his investments. What most people don't know is that Warren Buffett believes his IQ had nothing to do with his success as an investor. Warren Buffett says all you need is an average IQ to become successful with investing, and that everyone can become rich beyond belief. In this video, we're going to share Warren Buffett's investment strategies called value investing that you can apply immediately, so you can follow in his footsteps for financial success and freedom. Understanding value investing. Before diving into the intricacies of Warren Buffett's investment strategy, it's crucial to understand the core concept of value investing. Value investing is a method that involves buying stocks that appear to be undervalued, based on a thorough analysis of the company's financials and potential for growth, and then holding on to those stocks for years until they achieve their deserved market value. It's a calculated long-term approach that focuses on the intrinsic value of a company rather than short-term market fluctuations. The key principles of value investing are: focus on intrinsic value. Value investors look for stocks that are trading below their intrinsic value, which is the true worth of a company based on its earnings, cash flow, and assets. By calculating the intrinsic value, investors can identify undervalued stocks with the potential for long-term growth. Margin of safety. The margin of safety is the difference between a stock's intrinsic value and its market price. Value investors seek a wide margin of safety to minimize the risk of loss and maximize the potential for profit. Long-term investment horizon. Value investing is not about making quick profits or timing the market. Instead, it's about holding on to undervalued stocks for an extended period until their true worth is recognized by the market. This approach requires patience, discipline, and the ability to ignore short-term market noise. Focus on quality. Value investors prioritize companies with strong fundamentals, such as a robust business model, competitive advantage, and a solid track record of financial performance. They'd avoid companies with poor financials or unsustainable business practices, as these are less likely to deliver long-term growth. Diversification. To minimize risk and protect their portfolios, value investors diversify their investments across various industries and sectors. This approach helps to mitigate the impact of individual stock underperformance and ensures a more balanced and resilient portfolio. Contrarian mindset. Value investors often adopt a contrarian approach, going against the popular market sentiment. They look for undervalued stocks that others may have overlooked or dismissed due to short-term factors. This contrarian mindset allows value investors to capitalize on market inefficiencies and uncover hidden gems. By embracing these key principles, value investors aim to achieve superior returns over the long term while minimizing risk. Warren Buffett, a staunch advocate of value investing, has applied these principles throughout his illustrious career, demonstrating the strategy's effectiveness and resilience in various market conditions. Now we will delve deeper into how Warren Buffett applies the principles of value investing in practice, revealing the secrets behind his extraordinary success as an investor. Investing in companies you know. One of the fundamental tenets of Warren Buffett's value investing approach is the importance of investing in companies you understand. This means focusing on industries and business models that you're familiar with and knowledgeable about. By doing so, you're better equipped to analyze a company's potential for success, evaluate its competitive advantage, and identify any potential risks associated with its operations. Understanding the industry and business model enables you to move beyond gut feeling and speculation, providing a more solid foundation for your investment decisions. It allows you to critically assess the company's performance, growth prospects, and market position relative to its competitors. This depth of knowledge is crucial in helping you identify undervalued stocks with the potential for long-term growth. To illustrate this point further, let's consider Warren Buffett's investments in Coca-Cola and Apple. Although these companies operate in very different industries, Buffett has a solid understanding of both their business models and their respective markets. His knowledge of these companies and their industries has allowed him to make informed decisions that have generated significant returns over time. It's also worth noting that investing in companies you know doesn't mean you should only invest in industries you're currently involved in or have personal experience with. Instead, it's about recognizing the value of understanding the businesses you're investing in and dedicating the time and effort required to develop that understanding. Investing in companies with a competitive moat. A critical aspect of Warren Buffett's value investing approach is identifying and investing in companies that possess a competitive moat. A competitive moat, sometimes referred to as an economic moat, is a unique advantage or set of advantages that a company has over its competitors, making it difficult for others to replicate or challenge its market position. This competitive edge enables the company to generate long-term, sustainable profits, making it an attractive investment option. The importance of a competitive moat lies in its ability to protect a company from competition and market pressures, allowing it to maintain or grow its market share, pricing power, and profitability. Companies with a strong competitive moat can often withstand economic downturns and other adverse market conditions better than their peers, making them more resilient investments. Some examples of competitive moats include brand loyalty. Companies with a strong, recognizable brand often enjoy customer loyalty, which can translate into repeat business and pricing power. Examples include Apple, Coca-Cola, and Nike. Patents and intellectual property. Companies that hold patents or possess unique intellectual property can protect their products or services from being copied or replicated by competitors. This protection can lead to a sustained competitive advantage. Examples include pharmaceutical companies with patented drugs or tech companies with proprietary software. Network effects. Some businesses benefit from network effects, wherein the value of their product or service increases as more people use it. This creates a self-reinforcing cycle that can be challenging for competitors to break. Examples include social media platforms like Facebook and online marketplaces like Amazon. Economies of scale. Companies that can produce goods or services at a lower cost per unit due to their size and scale have a cost advantage over smaller competitors. This advantage allows them to generate higher profits. Investing in companies with a good management team. Another cornerstone of Warren Buffett's value investing philosophy is investing in companies with a strong, competent management team. The rationale behind this is that a company's long-term success is heavily influenced by the decisions made by its leadership. As a shareholder, you want to ensure that the management team is committed to protecting your interests and driving the company toward growth and profitability. The third tenet of Warren Buffett's value investing strategy is the focus on long-term investing. Unlike short-term traders who buy and sell stocks frequently, hoping to capitalize on short-term market fluctuations, Buffett believes in investing in fundamentally sound companies and holding onto their stocks for an extended period. This approach allows investors to benefit from the compounded growth of their investments over time, ultimately leading to potentially greater returns. Warren Buffett's long-term investment strategy is based on the idea that well-managed, undervalued companies with strong competitive advantages will eventually realize their full potential, leading to increased stock prices over time. By holding on to these investments for several years or even decades, investors can ride out short-term market volatility and benefit from the company's growth and success. However, long-term investing requires a significant degree of patience and resources. Investors must be prepared to commit their capital for extended periods, potentially foregoing other investment opportunities in the meantime. Additionally, since the strategy relies on identifying undervalued companies with strong growth potential, investors must be willing to dedicate the time and effort required for thorough research and analysis. Despite these challenges, long-term investing can offer several advantages over short-term trading. Firstly, long-term investors are generally less affected by short-term market fluctuations, allowing them to make more rational decisions and avoid the emotional pitfalls that can plague short-term traders. Secondly, long-term investing typically incurs lower transaction costs and tax liabilities, as investors hold onto their stocks for longer periods and trade less frequently. Investing during market panics. One of the hallmarks of Warren Buffett's investment approach is his ability to identify and capitalize on opportunities during market panics or downturns. When markets are in turmoil, many investors may panic and sell their holdings, leading to a general decline in stock prices. However, savvy value investors like Buffett recognize that such periods can present unique buying opportunities, as fundamentally strong companies may become undervalued due to widespread market pessimism. However, there are challenges associated with investing during market panics. One of the primary difficulties is identifying which companies are resilient enough to weather the storm and rebound once the market recovers. This requires a deep understanding of the company's financial health, competitive position, and industry dynamics, as well as the ability to distinguish between temporary setbacks and more severe, long-lasting issues. A notable example of this investment approach in action is the market crash caused by the pandemic. While many businesses faced significant challenges and some even went bankrupt, others proved to be more resilient and managed to recover and thrive once the crisis began to subside. Investors who were able to identify and invest in these resilient companies during the market panic would have likely seen substantial gains as the market recovered. Except that you will make mistakes. Even Warren Buffett is not immune to making mistakes. The key to long-term success in investing lies not in avoiding errors altogether, but in learning from them and incorporating those lessons into future investment decisions. Warren Buffett has been candid about some of the missteps he has made throughout his illustrious career. For example, he has referred to his investment in Berkshire Hathaway, a textile company, as the dumbest stock he ever bought. He acquired a controlling interest in the company out of spite, after a disagreement with its management. This impulsive decision cost him an estimated $200 billion in the long run, as the capital could have been deployed more effectively elsewhere. Another notable mistake Buffett made was his investment in Dexter Shoe Co., which he purchased for $433 million using Berkshire Hathaway shares. Unfortunately, Dexter Shoe Co. did not perform well, and the shares used to purchase the company eventually rose in value to $5.7 billion. Additionally, Buffett failed to sell his stake in Tesco before the company revealed that it had overstated its profits, leading to a significant drop in its stock price. From these experiences, smaller investors can learn several valuable lessons. First and foremost, it is crucial to approach investing with a rational and analytical mindset, avoiding emotionally driven decisions. Additionally, investors should always be prepared for the possibility of making mistakes and should incorporate risk management strategies into their investment approach. This can involve diversifying investments across various sectors and asset classes, as well as setting stop-loss orders to limit potential losses. It is essential for investors to remain humble and willing to learn from their errors. Just as Warren Buffett has been open about his mistakes and has strived to learn from them, smaller investors should adopt a similar attitude. By acknowledging and analyzing past errors, investors can identify patterns or weaknesses in their decision-making process and work to improve them over time. This continuous learning and self-reflection can contribute to long-term investment success. Finally, it is crucial for investors to recognize the limits of their knowledge and expertise. Warren Buffett has often emphasized the importance of staying within one's circle of competence when making investment decisions. This means focusing on industries and companies that an investor genuinely understands and avoiding investments based on speculation or hype. By staying within their circle of competence, investors can make more informed decisions and avoid potential pitfalls. As aspiring investors, we can draw valuable lessons from Warren Buffett's experiences and approach to investing. By adopting a disciplined long-term perspective and focusing on the fundamentals of the companies we invest in, we can significantly improve our chances of success in the market. Embracing the importance of learning from our mistakes and managing risk is also essential, as even the most accomplished investors like Buffett have faced setbacks along their investment journey. Thank you for watching the video. If you liked the video, please subscribe to the Finance Bowl for more money and investing tips. Until next time.